So let's consider where we are. We have Mum and Dad Proprietary Limited, and the company has paid for a number of expenses that should have been paid by Dad personally. They're personal expenses that have been paid by the company. That's where we're at. Also note that we're in chapter 14 of the book, the Australian Master Bookkeepers Guide, and essentially we're going to discuss what FBT is right now. And the first thing to note is that it is a tax paid by the employer. It's not paid by the employee. So the tax is paid by the employer. Now the employer could be a sole trader, a partnership, a company, or a trust. Now the tax is paid on the non-cash benefit provided to the employee. So we have a relationship between the employer and the employee. They're definitely connected, but there can also be a relationship between the employer and the employee's associate. Now we'll discuss that a little bit later in an example. So let's consider some features. We know that the employer pays the tax, that's one. The tax rate, or the rate of FBT, is 47%. Now let's think about that number, 47%. We've seen that before in previous classes and lectures. It's an incredibly high number. We don't like it. So do you really want to pay 47% on a benefit, or for that matter, anything else? Do you really want to pay 47%? My answer will be no. I prefer to pay a lower rate of tax, and we'll come back to that later. But for now, just realize the rate is high. The rate of FBT is very high. Now the other thing to note is it's paid on the grossed up taxable value. And the thing that I would like you to take away here is that's not the amount of the expense. If you realize one thing at this point in time, that grossed up taxable value is not the amount of the expense. Our next point, the FBT year runs from 1 April to 31 March. Now this isn't the normal tax year of 1 July to 30 June. It's at a different period. Now as an accountant, I don't mind that, because at that time of the year I'm busy, but I may not be as busy as I am at the end of financial year. So here we see an annual FBT return may be required, and it's required to be lodged by the 21st of May if you're putting in a paper return, or by the 25th of June if you're lodging electronically. So where are we? Let's say we have Dad's telephone bill. His personal telephone bill is $110. Well, the employer is going to pay for that. The employer will claim a tax deduction, but it's also going to get a tax deduction for the FBT paid and that calculation. Now we're going to come back to this, and that may sound a little confusing at the moment, so we'll come back to this shortly. I will say this though, what we will soon discover is that this is not a good thing. It's not a good thing. And if you're Mum and Dad Proprietary Limited, Mum and Dad are shareholders and employees, you don't want to do this, and I'm going to prove that to you shortly. Now the final couple of things here, the FBT is paid on a self-assessment basis. What does that mean? It means you're responsible and you don't want to get it wrong. Penalties can apply. Good news if you're an employee, there is no tax to pay. And finally, FBT is payable whether you make a profit or loss. You can be in a loss-making situation and it will have nothing to do with whether you pay FBT or not.